welcome everybody. Happy Wednesday. I am very excited to go ahead and kick off our Future Proof call today. In case we have not met before, my name is Melissa Langdale, and I'm the founder and CEO of Praxis Lending Solutions. We are a premier mortgage consulting firm on a mission. And our mission is actually very simple. It is to leverage technology and intentional workflow design to lower the cost of origination for all of the lenders that we work with. So as you can imagine, I spent a lot of my time talking with lenders about designing their workflow and their technology to be better prepared for the future of what is coming. And so that is why the series was created and why I'm so excited to be able to share it with all of you guys today. But before we get started, I want to highlight our marketing genius and production partner that is often working behind the scenes for us, but James Duncan from Kylum Advisors. James, thanks so much for being a part of so much of what we do with Future Proof. Can you tell everybody a little bit about why you started Kylum Advisors and what maybe the industry was missing that your agency helps to provide?
Well, in all of my years of running marketing divisions and building what I believed were world-class marketing teams, and then seeing margin compression or things tighten up in the industry, and that resulted in either having to make cuts or scaling back budgets, it got pretty frustrating for me to watch. And because I discovered that most mortgage companies still treat marketing as a cost center, when things get tight, the budgets get cut, and companies are missing opportunities every time when the market shifts. So I started Kylum Advisors because this industry desperately needed a partner who understands both the fundamentals of great marketing as well as the realities of mortgage lending. And so we bridge that gap, and we help mortgage leaders and executives and heads of marketing divisions at mortgage companies turn marketing into a true growth strategy and a growth engine, not just an expense line in the budget. So if you're ready to break that cycle and stand out in a very crowded and commoditized market, then would love to visit with you and learn more about your business and how we can help.
I love it. We're excited to have you as a part of this Future Proof series. I know for everybody there that would like to get in touch with James, he'll put his contact information in the chat for all of you as well. Like I mentioned, this series is all about kind of preparing your companies for the future of mortgage lending. And it was really designed with 6 weeks of jam-packed content. We've talked about so far the future of mortgage manufacturing. We've talked about high-tech and high-touch solutions. And last week we talked about AI and all things AI. We learned about agentic AI and the risk and the reward. And I will tell you, for those of you that joined us last week, we did not get to our debate on the actual ROI of AI solutions. So I will schedule that afterwards. We just ran out of time because we had so much fun things to cover. So be on the lookout. That is coming. This week's discussion is all around the future of mortgage regulation. Next week, we're going to talk about maximizing tech adoption, and then we're going to finish out the series with a discussion around preparing your company for the next generation of mortgage professional and the next generation of home buyers. So excited to see all of this come together. And none of this series would be possible without a group of incredible speakers who have come along beside me to deliver all of this content. So let's go ahead and introduce today's speakers for you. Not that either one of them need much of an introduction, but I will go ahead and do it nonetheless. Greg Shear, who's the Managing Director of NFM Lending, and Taylor Stork, who is the COO of Developers Mortgage, but also the president of CHLA. Greg and Taylor, thank you so much for joining us today.
Pleasure. It's good to be with you. Thank you for having us.
Yeah.
Thank you very much. And I have to apologize in advance. I've got very, very bad internet skills. I am literally in Washington, D.C. at the George Hotel right this second, on the heels of a number of very important meetings over the last couple of days. And it turns out that the George's internet is just not very good. So there may be a little bit of streaming blips here and there.
All right. Well, we'll deal with them together, my friend. I'm excited to have you with us, and we're going to have lots of great discussions on everything that you've talked about, I'm sure, while you're in DC. But I like to start off every one of these sessions with a little bit of a dreaming session because it's called future proof. And so we have to talk about all the things that are possible in the future. So I'm going to ask you both a question, but I'm asking the audience with us as well today this same question. And y'all have already heard this question. It's actually my most favorite question to ask everybody, but I'm really curious to see if your answers have changed over time. So my question is, if you had unlimited resources, you don't have capital constraints, you don't have technology constraints, you might have a little bit of influence over policy and regulation, but you could only fix one thing in mortgage, where would you start? So I'll start maybe.
Start with him. Let me think about that one.
Okay, yeah. I'll start with Taylor.
Yeah, you have to start with the guest that has the higher IQ. So please start with Taylor. And I'll likely just piggyback off of whatever he says.
So if I had all the resources in the world and I could only fix one thing in mortgage. Wow. Listen, not to double down on the policy space and the regulation space, but that's what I'm going to do. Wow. We have over-regulated the mortgage business to the point that a huge amount of expense is borne by our customers as a result. I spent yesterday talking about this with Mark Calabria at the White House. I spent yesterday talking about this with members of the House Financial Services Committee and a number of other policy leaders in the space. Over the years, we have aggregated together so many different regulations, both state and federal, that lenders, whether they are IMBs or mortgage brokers or banks or CDFIs or credit unions, we literally have to try to dance through the raindrops without getting wet. And what most people in our business or outside of our business don't understand is that the mortgage business is a zero defect business. You cannot have a defect. There's zero variance allowed. One single error and that loan has to be repurchased. One single error and that loan doesn't get to go get insured by FHA, can't get sold to Freddie Mac. We literally operate in a model that requires nearly absolute perfection. And we do so with anywhere from 10 to 20 to 30 to 50 plus regulatory bodies, double checking every single thing we do. And what that does is it is a force multiplier effect on the cost of origination. You know, if you talk to anybody about what drives costs up, and you know, we've heard lots of numbers thrown around recently: 9,000 per loan, 12,000 per loan, 14,000 per loan. It kind of depends on how you do the math and what factors you count. Those costs tend to identify kind of the big bulk items, but they don't account for the amount of effort and constraint to try to navigate through raindrops within each item that layers in additional expense. And ultimately, mortgage companies don't pay that cost, our borrowers do. It makes buying a home far more expensive. It's why we have spreads instead of 150 basis over the 10-year, why we're nearly 300 basis points over the 10-year. It's why our costs have skyrocketed. In every single thing we do, our costs have skyrocketed far more than the inflation rate that we've seen over the last few years. So if there was one thing I could do with my resources, it would be to massively deregulate, but in a way that is smart and thoughtful. Remove all of the excess, duplicative, and in some cases, outdated, old, and completely unnecessary regulation that causes lenders, whether it's Greg at NFM or me at Developers Mortgage or Rocket or UWM or every single independent broker on the street, that causes us to have to try to dance through the raindrops without getting wet, which is impossible to do.
I love it. I think we need to start measuring the cost of compliance and not just the cost of origination. I think home builders are able to do that a lot easier than we are. So please don't get me wrong, but I would love to see us start to measure that and understand the impact of it.
I just like the visual of Taylor dancing, whether it's in the raindrops or not in the raindrops. I don't look at Taylor and think this guy can probably dance. I don't know. I definitely can't, by the way. Taylor, can you dance?
I can dance. I've got soul.
I would love to see that. I want to see that.
I love to visit Austin and do a little two-stepping. So Melissa, the next time we're there, we're going to do some country swing.
I would
I have
love
three choices. I have three things that I would change. So I know you said only one. So I'm only going to give you one.
Okay.
And I'm going to mention the runners up.
Then.
Can I mention the runner ups? Okay.
Sure. Yeah.
LO comp.
Yes.
I would definitely address that, but that's not my leader. Okay.
Yeah.
I mean, I think if you want to set your bar where it is, and anything that forces you to go down that gives the borrower a better outcome, to me, why are we going to pick that apart and split hairs over that? I think that's another example of what Taylor's talking about, which just ties people up. And a lot of people are living in fear based on the previous CFPB and their way of ruling by enforcement. So I'd love to get some clarity on that. That's not number one. Kind of a combination of things to loosen up inventory in the market would be another. There are, I think, 2 million vacant properties that the government has control over. I believe there's about 12 to 14 million at last check vacant properties that are owned by foreign lands and people in the U.S. that aren't currently occupying them. I mean, that's a lot of property, and then speed up the process of using whatever government land we can to build on. And granted, it's 644 million acres or so at last check, and only a small percentage, like well below 1%, can be used, but it's still a big number. So they've talked about it. It'd be great if they wouldn't wait 10 years to make that happen. I think 3D printing would be a good thing too, because they can throw up properties very fast. But the number one thing, any drum roll here? All right, no drum roll.
I can't do it. I'm terrible.
and this is something I talked to Tim Bowler, the president of ICE Mortgage Technologies, about. I'm going to name drop a little bit. And I talked to Mark Calabria, although Taylor's already name dropped him. So I'm just piggybacking. I told you I'd piggyback off of him. Incentivizing people to get out of their lock-in effect. And so one thing that Mark has talked about is, he said he's been shopping this. He told me this a couple months ago, and I followed up with him about 10 days ago, and he said he's still trying to pitch this idea of not having capital gains for a 2-year period. That's an idea, and I think that the government can come in and subsidize. If you've got 4% or lower, potentially they could buy the coupon down to 5.5% or 5 3/4. Do something to loosen up that lock-in effect. And the quicker we get from 65% of people below 4%, whatever the latest number is, that's not an updated number, but the quicker we get that down into the 30 to 40% range, the more we're going to see things loosen up. And so that would be the number one thing, is find a way for the government to get involved and encourage people that are at these really low rates. Incentivize them to get out. Maybe allow them to use, I mean, not crazy ideas. Let them use more like, I have 2 kids in private school, right? I can only use $10,000, which was a gift, by the way. That was the last Trump administration, the 529s. It used to be you could only use that for college. Now you can use it K through 12. Yeah. So maybe if I get out of my 3% rate, I can turn that 10 grand into 20. That would be a huge lift for me. Maybe I would consider doing that. And I think there's a lot of things that they can do to get people to consider maybe getting out of their homes. So that'd be number one, is some kind of a program to incentivize folks to get out of their below 4% rates.
I love it. That's a great, and actually one of the things I had slated for our topics today, mine was actually very similar to Taylor's, and it was around creating uniformity between federal and state, requirements for lenders. I think it's that difference that it creates complications for lenders to try to comply with, as he mentioned, that kind of dancing in the rain, which, by the way, I foresee, if I could predict the future, a meme of Taylor dancing in the rain after this. But also, I think it creates, just like Taylor said, a ton of complications for consumers. If they have gotten a loan in the past in Texas and now they're getting a loan in North Carolina, there's fees that are going to be called different things. There's going to be different requirements. Like, it creates too much complexity for customers to try to navigate all at the same time. So I'm so excited for this conversation. We've hit on all of the important things within the first 10 minutes of our call here.
So we're done. We're
no, we're not done. We're not.
All right, take care.
We have an hour slated for this. I promise I'm going to try to get us out of here before then, because I recognize everybody's time is super, super valuable. But we have a ton of content to try to cover today. For everybody that's joining us too, we want this to be super interactive. So put your questions in the chat. I promise we'll try to get to them throughout our conversation today. If something crazy happens and we can't get to your question, I promise to follow up and make sure that we get those answers for you afterwards. So we're going to start actually today's conversation with kind of level setting where we're at today. And then I'm going to ask Greg and Taylor some fun questions that we can use to help kind of predict where we're going in the future. So let's kind of level set. We'll go ahead and get started with level setting where we're at today. And Taylor, as you mentioned, you have had CHLA in DC these past couple of days. So why don't you give everybody just, kind of a little bit of an overview of CHLA, and then maybe your top probably 2 or 3 things that you talked with everybody about while you're there.
Sure, I'd be happy to. Thank you for that. So CHLA is the Community Home Lenders of America. It is a trade association, an advocacy group, but it is different from many others. It is a very grassroots organization. Our members are personally involved and personally actionable. We get out of our seats at the office and we come to Washington, D.C. and our members literally sit across the table from the people that are making decisions about what this industry looks like going forward. Over the last couple of days, we've met with all of the various agencies and organizations in DC that determine what housing looks like, from GSEs to federal regulators to meetings at the White House to talk about housing and policy. We've met with staff and met on the Hill for congressmen and senators, House Financial Services, Senate banking, and so forth. And it is an opportunity, membership is an opportunity to learn specifically about how policy impacts mortgage, and also to participate in helping shape what that policy looks like. We have taken a very active role in proposing solutions, including proposing many of the changes that we saw take place within the CFPB, proposing changes that are currently taking place within the FHFA. We believe that we've had a very positive impact on a number of those items. We sent letters to Director Pulte and to Director Pulte and Acting Director Voigt, suggesting a number of the changes that we've since then seen get implemented. So our conversations and our actions and activities have been very positive. So I hope that answers the first half of that question. Kind of the top 3 things that we've been talking about while we are here, a lot of those things have centered around what the CFPB is going to look like in a post 45th administration world, right? So there is an understanding and a consensus that CFPB exists by statute. And unless that statute is repealed, the CFPB is not going to stop existing. In order for a statute to be repealed, you have to have 60% of the Senate agree. And the current party in control, the Republicans, don't control 60% of the Senate. And that is unlikely to change at midterms, which means that in all likelihood, there will still be a CFPB in 4 years, albeit it may look very different than it looks today. So one of the things that we've been really, really focused on is how to navigate through changes that are systemic changes to the CFPB, changes that bring in a bright line enforcement model and supervision model, changes that are more specific, that can withstand a cabinet change and an administration change. So you can issue executive orders all day long. You can make policy changes and management changes internally. But rulemaking tends to have a much more sticky effect and last longer. And the rulemaking process is very specific, but ultimately statute is what will make changes far more permanent. So a lot of those items are what we've been talking about with the White House, with Senate and House Republicans and Democrats.
That's great. Well, and I do want to say too, for Taylor and Greg and everybody that's here with us too, This is going to be a little bit less of a panel discussion and more of a roundtable. So y'all just jump in if you've got some stuff to add as we go through this. I want y'all to be comfortable with that.
Yeah.
Obviously, there's a ton of changes at CFPB, which you've talked about, kind of CHLA taking some stances on. They just kind of recently announced that there's going to be a reduction in supervisory exams. And that a lot less time would be spent on supervisory activities for IMBs.
Yes.
And so we're starting to see some states kind of stepping up and taking a stronger stance on some of the things that CFPB used to take strong stances on. And so I'd love to hear maybe from each one of you guys on, is this already impacting your companies, or where do you see the impact coming in the future?
Yeah, for sure. I can speak to that. I spoke to Latasha Waddy, who's our chief general counsel, early this morning to let her know I was going to be on this, and I needed her to program me as to what to say. No, I'm just kidding. Well, obviously she's in the trenches, so she knows. And, in blue states, they continue to be very concerned about consumer-facing interactions. In the red states, more about the business structure, how well capitalized are you. It is the concern, though. It's the biggest concern is that they're able to govern, RESPA and other federal laws, and it's not clear federally if that's going to happen. So the states, I think, do feel emboldened. And we now see that a lot of the folks that were in the CFPB are moving into the states. Yeah. And so they're quite familiar with how to chase down mortgage lenders. Now, having said that, if you play by the rules and you continue to do things that the way you're supposed to do it, and you're responsive when they have questions, you're good. I asked Latasha this morning, I said, well, is there, and the one thing I asked is, do states share with other states? And she said, yeah, well, if you request it, a lot of states are not required to share, but many are, they work with these other states, right? And they're friendly. So you can imagine, I said to her, one state bleeds into another state, bleeds into another. Could there be a situation where a company that's licensed all over the country all of a sudden feels the weight of the world coming down on them from 49, 50 states? She said, that's not really how it works. Don't worry about that. We just have to fly. We just have to fly straight. But, the states can be, that's tricky. It's almost a be careful what you wish for scenario, right? We went from governing through enforcement to now, and that's one entity, to now a world where potentially we've got 50 people coming from 50 different directions. So I think it remains to be seen. Fortunately, you've got a lot of red states, and they're probably going to come after mortgage lenders with less aggressiveness than the blue states. But I will say, Mark Calabria, I went to a roundtable led by Rick Sharga in D.C. at Cooley Law Firm, beautiful building in the heart of D.C. about 2 weeks ago. And one thing he did say is that the CFPB, because the states are stepping up, he expects them to look at banks a lot closer than they did, whereas in the past, non-banks were getting 2/3 of the focus. That equation now is being flipped around. I think that's a very interesting thing to point out here, that now non-banks are going to be scrutinized much less than they were previously. So that is something that's absolutely worth noting here. That, but again, that other third that we're losing, the states, who knows how heavy that's going to feel on us.
Yeah.
Yeah. And just to put an underscore on Greg's point, there are 4,997 banks that aren't even governed by the CFPB because of the size of the banks and because of the exemptions that exist. There is no such thing as 4,997 IMBs that aren't governed. In fact, there is no such thing as one IMB that is like, there is no exemption whatsoever for size. If you are an IMB and you do 10 loans a year, you have to worry about the CFPB showing up and doing exams. And actually, to Greg's point, there is sharing, and the CFPB will and has been well known to go obtain the state results, even when those state exams were passing and positive, and then decide that they disagreed with the state's findings and then pursue action against individual IMBs in those states where they passed the exam in the first place. There are some egregious actions that have taken place over the last many years that have quite literally run IMBs who did nothing wrong out of the business. And that is the fear. That is the dancing through the raindrops. So my mortgage company, Developers Mortgage, is licensed in the state of New York. And for those of you that don't know, the state of New York is the most difficult place to maintain a license. Regardless of whether there's a CFPB, they were hard before and they will be hard after, and it's not going to make a difference. There will always be states that regulate the lenders where they operate. Texas, Melissa, you live in Austin, Texas. Texas is a red state, and Texas has a very strict RESPA law that they enforce, regardless of whether there is a federal RESPA law. Ohio is a red state, and they have very, very strong enforcement actions under the RMLA. Very strong.
Yeah.
In fact, the Ohio Attorney General recently announced an action against a mortgage company for violation, one of the largest, maybe albeit the largest mortgage company, for violations of Ohio state law as it relates to the RMLA for lending. And I'm licensed in Ohio, so I'm very familiar with the Ohio state law.
Yeah.
We are state licensed organizations. And when I spoke with Mark Calabria, Greg, name drop the mic. One of the things that Mark was very clear on is that your regulator should be where you are licensed. We do not have federal licenses. It doesn't exist. There's no such thing as a federal license. And therefore, one of the things that was pretty clear is that the vision of the new CFPB is that the CFPB is supposed to step in where the natural regulators are unable because of size and scope to really be effective. And where a regulator can step in is where a bank has preemption. So banks, depositories, federal depositories have what's called preemption as a result of an 1863 law called the National Banking Act. So 1863, during the Civil War, that's why banks don't have to adhere to state level laws. And that's why the CFPB does need to focus on depositories and not on IMBs. IMBs are subject to the laws of the states where they are licensed. And IMBs can choose to exit those states. If you don't want to be in New York and be regulated by New York regulators, surrender your license and go focus on another state. You have that option. You do not have the option of surrendering out to the CFPB unless you decide you're just going to exit the business entirely, which a number of mortgage companies have had to do because of some of the egregious actions over the last few years. I met with one of those mortgage companies yesterday. So I welcome all the changes that are taking place. In fact, CHLA is working closely with many of the leaders I've mentioned earlier to put together proposed legislation to help define what the future looks like, to make sure that the regulations that are being enforced in appropriate percentages, and that we are actually paying attention to the tiering model that was originally envisioned when the CFPB was created. Because if you read Dodd-Frank, the CFPB was supposed to be doing enforcement based on size and scope, and they have lost sight of that. And thank God the new people in charge are refocusing on ensuring that the CFPB is picking up the slack where they need to, where a state regulator can't do the job.
Yeah. Well,
I have a little nugget for you to think about.
Okay.
This will be a little mind blowing. It's a little head twister here. So we recently had an audit with a state that went directly to our credit vendor to get all of our credit report data. They were looking for unlicensed activity. Just think about that for a minute. Think about a world where the states are able to bypass, because normally a state comes to you, hey, give me this, give me that. You choose what to give them, right? I mean, you're giving them everything, obviously, but you're teeing it up the way that you interpret what they're saying. Well, there's no interpretation, and a lot of our, if not all of our agreements have language with our third-party vendors that we're federally governed. If they need something, you've got to be cooperative. Just think about that for a minute. If the states just all decide to be hitting up our vendors that have our consumer data, what kind of windy road that is going to turn out to be.
Well, the challenge is, especially in companies where they have multiple vendors for services, right? There could be some things that could be missed along the way too, but it does absolutely create lots of challenges.
But at the same time, you can leave a state. You can't leave the country.
Yeah. Well, so my concern, you talked about this actually, Greg, one of your wishes was LO comp. right? And so as we start to think about like the changes that are happening at CFPB, the likelihood of overturning LO comp or revising LO comp rules the way that they are today, I think becomes less and less, right? If they're kind of focusing on other things right now, they've reduced their staff, that all the things that are happening, like, so that's a concern for me. I mean, that LO comp law was what, in 2010? That was 15 years ago, and so much has changed about our industry since then.
When it's not even functioning the way it was supposed to be functioning. The LO comp is not. Taylor can explain because he works right alongside Scott Olson, who helped to write that bill. It's not even what it was supposed to be, right? And here we are 15 years later, but I know I'm cutting you off. I'm so sorry. Forgive me for that. But I'm a lot older than you and I forget stuff, Melissa, so I have to say what's on my mind when I think it. That's my excuse. It's old age. But like the GSE's coming out of conservatorship. Like Mark Calabria told a big group of people the same conversation we had 10 days ago. That's not even a 25 thing. It probably isn't even a 26 thing. The topic of FICO and the Fair Credit Reporting Act that passed in 2019 that gave FHFA and the director the mandate to bring in competition in the credit space. I mean, he when I asked him, hey, what happened when you were running FHFA and this was under you? And are we going to have another, is Vantage Score or somebody going to be able to step up to be competitive to the law, to the letter of the law that it was intended? He basically scoffed at that and said, man, you talk about low priorities. Like, I don't think they want to go back into that hornet's nest. So personally, it doesn't seem to me like LO comp, unless it's something that they can change quickly. Does it take congressional approval, Taylor? I think it does, right? Yeah. So I mean, that's the challenge, right? Is what can you fix where you can just wave a wand and check a box, and what is going to take, more unanimous decision making in order to get something done. And now, of course, we're on the heels of the tax extension budget, and so they're going to be jockeying and fighting over a million things right now. And I doubt LO comp can be snuck in there.
Well, let's talk about, go ahead, Taylor.
There may or may not be an organization that is navigating through proposed legislation to be added into other bills to address LO comp. Okay. And I don't want to take full credit for it, but I think there is a scenario where LO comp can be addressed from a statute and legislation perspective. Okay. Greg made a very correct point. When LO comp was first envisioned, the whole point. So I want to remind everybody, LO doesn't stand for loan officer. It stands for loan originator, right? 100%. Okay. So what we we think of the SAFE Act. The SAFE Act is squarely about loan officers. We know that the SAFE Act is LOs, right? But LO comp is really about loan originator comp, right? So when it was envisioned, and I know people that were in the room navigating through this thing, the point of it was to stop the practice of the YSP markup, right? So back in those days, there were yield spread premiums and business between two firms. One firm would tell another firm, if you charge more, then we'll pay you more. If you charge a higher rate, we'll give you more yield spread premium on the back end. So those of us that have been in the business for a few years remember what a back end was on a loan transaction. Number one, today with TRID, you can't do it. You really can't do it. But you can navigate your way around it if you are there are a few kinds of lenders structures that can navigate around it if they know what they're doing and have gotten pretty proficient at doing so. So the entire original purpose of LO comp, the LO comp rules, was to stop the markup and then the requisite or the following yield spread premium distribution as a reward. Yeah. It was never envisioned to dictate how an employer could pay their employee. It was never supposed to decide that Greg couldn't determine that one loan officer was on one comp plan and another loan officer was on another comp plan. It was never intended to stop bond loan programs from being originated at all, because we are unable to originate loans at a loss. And everybody knows if you're in the mortgage business, we're not allowed to lose money. It's literally forbidden by HUD, by our warehouse lenders, by everybody there is. We're not allowed to lose money, whether it's on one single transaction or on the aggregate. And so the LO comp model was never envisioned to stop us from offering our consumers the best possible deal, which oftentimes is a bond loan. Oftentimes the bond loan is the best deal. Oftentimes we want to go back to our consumer and we want to say, hey, we locked you in, but rates have come down. We want to give you a better deal. Here's how it's going to work. Well, LO comp stops us from doing those things, because when you layer in LO comp with the requirement that we not lose money on our transactions and we all remain going concern entities, you can't do it. And that is part of the conversation. There has been an unintended consequence of that legislation, which was never thought out, never envisioned, and was never supposed to happen. And that's one of the things we do have to fix, and we have to do it legislatively. And there are many people in DC that are very open to doing it.
Yeah, there are a lot of unintended consequences around regulation sometimes, right? Especially around the longer things are around, the interpretation of all of those things often lead to unintended consequences. Let's transition to something that's a little bit more positive. Let's talk about trigger leads. Obviously, there's a bill in the House. There's a bill in the Senate as well. And I know it's gotten a ton of support, but would love to hear, especially Taylor, since you've had some conversations recently, and maybe Greg from you too, if you were talking to Calabria about this maybe, or in your meeting a couple of weeks ago, maybe timing, is support still there? How do you feel about it?
Taylor?
Greg, I hate
you know how I feel about it.
So
we've
listen,
spent days talking about this, Taylor and I have.
First and foremost, I want to give credit to where credit is deserved. It was the National Association of Mortgage Brokers that launched the Trigger Leads effort. They're the ones that announced the Torres bill in the first place, which was the original bill that addressed trigger leads. It was followed by the Rose bill, and then that was followed by Senator Reed's office with a Senate companion bill, which was then subsequently attached to NDAA, which was then scuttled in the NDAA. But I don't think that we all give everybody that deserves it the right credit for the work that was done to get this effort started. Look, there's a certain reality here. The issue, and forgive me for speaking out of turn, we all hate trigger leads for a lot of reasons, but we need to bifurcate what a trigger lead is. The reason we hate trigger leads aren't because customers are offered a better option. It's because customers are inundated with unwanted calls and unwanted text messages.
Yep.
Those unwanted calls, in many cases, are bad actors who are pretending to be somebody else. Okay. We have found example after example after example of complete strangers, licensed and not licensed, texting and calling our customers saying, I'm your processor at your mortgage company. Please send me your tax returns. And here's where I need you to send them. The bad actors are stealing data. We're seeing clear attempts at privacy and identity theft that are using the trigger lead system to do so. We've also navigated through and identified time after time where the communications aren't adhering to the rules. So if you're going to make somebody an offer, it has to be a pre-screened offer. It has to be a legitimate bona fide offer. It's not a, hey, maybe call me and we'll see what we can do. It's you're pre-approved and here's the interest rate and here's the APR and here's my NMLS number to prove you that I'm a licensed person that can actually make this offer in the first place. And only a creditor can make a pre-screened offer. You have to have authority to actually make a loan to somebody. So you have to be licensed or be a depository. You have to have an NMLS. You have to have authority to make a loan in the first place, to bind that loan and issue a full-fledged bona fide commitment. And you have to do it the right way. And you have to honor your terms and you have to deliver. Pre-screen leads, pre-screen triggers, they're not so that you can text people and say, hey, call me and I'll quote you a rate. That's not what a pre-screen, that is bad acting. That is fundamentally bad acting. And that's the practice that has to be stopped. Now, whether it's a baby with the bathwater model, such as, some efforts, or whether it's a more surgical attempt, we need to enforce TCPA. We need to enforce licensing rules. We need to enforce the pre-screened rules under FCRA, the original 1970 FCRA. Mm-hmm. We need to enforce all the provisions so that our consumers are being guided the right direction and being provided the data and the opportunities that they should get, not to have their tax returns stolen and sold on the dark web. That's the real problem.
Yeah.
Taylor, if there was no trigger bill and there was just clear enforcement of the TCPA, isn't there enough in there to get it done?
Yeah.
If it was enforced? Yeah.
Yeah,
okay.
that's the
I
big
just wanna
joke.
throw that out. Yeah.
Just enforce TCPA and everything gets solutioned.
Yeah.
Yeah.
So I don't love the trigger bill as it stands currently, because there's a carve out in there for servicers.
That's right.
Yeah.
So I don't the original bill, as I understand it, did not have that in there.
That is correct. Torres had
So-
no carve outs, and then Rose introduced carve outs.
Yeah. So the fact that, to me, leave the playing field even. It's either everybody gets them or nobody gets them. The fact
Yep.
that now servicers who already own the retention game now have that extra leg up, I just think it puts the rest of the industry at a disadvantage. I don't like it for that reason.
And banks, your bank, if you have a checking account, your bank can trigger lead you if they want to, just because you have a checking account with them or a credit card with them.
Yeah.
So that doesn't sit well with me. I know you said this was gonna be a positive subject. I'm not sure how this was going to be a positive subject, but I mean, trigger leads, like, there's a lot of emotion around that. And let's be honest, what's really the driver behind whether something gets done or not is the lobbying and the money behind the credit bureaus. And you want to talk about something really effed up, man. It's the whole credit cartel. It's FICO, which is the only credit score that the GSEs will accept. The only way, then you've got the three bureaus, which together own Vantage Score, which is supposed to be the competitor to FICO. It's just the most screwed up thing. And the thing about it is, FICO could say, well, we don't sell trigger leads, which I think is true. I don't think they sell it. I think
FICO doesn't sell anything.
Yeah, the TransUnion one was it TransUnion that sells the majority of the trigger leads?
Equifax. It's actually Equifax
Okay,
that does the
but here's
majority.
the thing: what happens when you get a trigger lead from them? You buy it from them, right? You pull the credit. And every time you pull a credit, you've got to produce a FICO score. So FICO's in this. Their hand is in the cookie jar here, and they're getting paid every time a trigger is sold, and it's resulting in another credit report. And I would not be surprised at all, if Mark Calabria is being forthright that this is not a high priority, and other people in the administration. What is going to stop FICO from continuing their march and raising prices again?
I would expect it to happen.
I would expect it, unless mortgage volume suddenly picks up in the next 90 days due to some unforeseen circumstances, which I don't think is going to happen. I could easily see them going from 495 to 795 and just saying, to all of us.
You think
that's really concerning. That's a problem.
Let's just be clear. You think they're going to charge the exact same price for the traditional FICO as they are for the upgraded 10T? No price change for 10T? Give me a break.
I actually would like to argue that we might not even need traditional FICO Vantage Score. I'll just throw, with AI, I think there's so much possibilities that we can use to predict whether a loan's going to be, a good loan or not. So
yeah, but can you get the agencies to agree to buy that? Same thing with AI underwriting. Are there going to be rep and warrants around that? I saw in the notes somewhere. We might talk about this.
We're a long ways.
We're
a long ways from being able to do that. But I'd like to throw that out there as an actual viable solution down the road.
Yeah. Listen, we talked a lot about credit scores with a number of different people over the last few days, including the FHFA and including some of the agencies. And I can tell you that nobody is talking about credit scores right this second, because there are so many other things. Buy merge, try merge. I'm not worried about that. The plumbing is not built to even support buy merge, try merge. The plumbing is not built to even support Vantage. The plumbing in the system isn't built. So, legislative or not, regulatory or not, conversation or not, doesn't matter. We're not going to see anything happen in 12 months.
I think we can talk about, you want to try and spin this into some positive stuff, because we're 75% of the way in here. I talked to a very well-known CEO yesterday from an IMB, and he reported that they made very good money in the first quarter, and that they're feeling really bullish. And everyone, I think, has settled into the new normal, right? There's been consolidation. There've been some people that have gone out, but at the same time, there've been a lot of institutions like NFM and like Taylor's company that have really conformed to the times, whether it's using AI or deploying resources overseas to lower the cost to produce, to cutting unnecessary staff. I think the industry and those that are still here is very well positioned for this next run. And that's exciting. That's exciting. And I'll also say one other thing. There's the collaboration in this industry. There is no question it's never been bigger.
I agree.
Never, ever. Like CEOs talking to CEOs, C-suites talking to C-suites, managers talking to managers. I've never seen a more collaborative environment in mortgage than I exist today. And I think that bodes well for the future.
I love it. All of us, right?
Yeah, right there. That's I mean, then that's positive. You want to talk about positive. It's look, regardless of what comes at us, we are such a resilient group of mutts, most of us. I'm a mutt for sure. I was never supposed to be in this business. I doubt you two were either. But here we are, right?
Greg, you gave up a really promising career in modeling to do this, and I'm still trying to understand how Calvin Klein let go of you in the first place.
You asshole! Did you really say that?
Y'all,
I don't feel very attractive lately, Taylor. Wait till you're 54, buddy. I'll be calling you and making fun of you. Okay? I can't help it. I look like this.
I don't know where to go from this conversation.
No, I should say Taylor is
back in.
No, I'm joking around. I didn't see any disclaimer that I couldn't curse on here. Taylor is one of my closest friends and maybe the most brilliant mind in this business. So we joke around with each other a lot. I'm allowed to do that. Right, Taylor?
You are 100% allowed to do that, especially when you say things like you just said. I'll wire the money to you later.
I love it. Okay, so we talked a lot about level setting, even though we didn't get to everything that we wanted to get to, kind of where we're at today. I want to transition a little bit into maybe some predictions of the future from each one of you guys, as we only have about 13 minutes left here. So if each of you could predict maybe 2 to 3 things that you think our industry should expect over the next 12 months, let's wrap things up with that. Who wants to start?
You're gonna make me go first again.
No, I'll go first. I think there'll be more consolidation. I think Zillow is going to roll up into someone. I think that we're going to continue to see this movement towards agencies and mortgage brokerages teaming up to be one entity, and more of this vertically integrated thing that Rocket's doing, where you can offer all these ancillary services. Whether it's good or not for the consumer, they're clearly two very clear positions to be taken on that. So that's one thing. I do have another vision that I've been talking about lately, and I did a poll, and at least half the institutions out there, IMBs in particular, are not using any kind of AI. And I don't know if it's because they think it's going to go away or what, but I think that they're in danger here, as Rocket and others are lapping the field every day. They continue to circle us and circle us and circle us, which is okay if you're doing things to lower your cost to produce, potentially using overseas, adopting AI, just scratching and clawing your way. Nobody's going to catch up to Rocket, I don't think. However, look at it as Rocket's over here and everybody else is over here, and then in between these two hands is a bridge, right? And those that are using AI now and that are working on their cost to produce feverishly, squeaking out a gain, like they're already halfway across the bridge. Those that are over here that just want AI to go away, I think that they're endangered species. Yeah. I think what's going to happen in the next 2 years, and Melissa, I'd love your opinion on this because this is the business you're in, helping out so many institutions now in your new role, is that the third-party vendor space is going to catch up, right? And so we've got so many brilliant minds out there in the third-party space that we rely on anyway for our ecosystem and to get loans done seamlessly. And they're working so hard, so many different institutions, to bring that efficiency into the mortgage space and drop it in. So I think that for the people that are on this bridge here, they're already halfway across because of the things they're doing.
Yeah.
And the third-party vendors that are going to bring this stuff into the space are just going to push them over, where then we start to catch up to Rocket. But make no mistake, the entities that have the resources, that have the public money, they are at a real advantage right now. And so if you're not doing anything and you're not adopting anything, I think you have problems ahead. You need to change that mentality.
I agree. I think your first point, I actually call that housing made simple. Like, every the home ownership journey being kind of in one entity or in a group of entities that can best serve the customer. I think we're going to see more of that as well. Now, I do not think we will see the local LO go away, so please do not get me wrong, but I think we're going to see more competition in that space is where my head is going. So the other part is absolutely why I started Praxis, and that is to help people to position themselves to better take advantage of newer technology solutions that are coming. Because I agree with you too, our vendors and our preferred, what I call partners in the industry, are going to be helping us to be able to lower our cost of origination in unique ways in the future. So Taylor, what do you think? What if you could predict maybe 2 or 3 things that the industry should expect over the next 12 months? What would they be?
Okay, so first I want to disagree with Greg because I love to do this. You said nobody's going to catch up with Rocket. I fully disagree with you because what do they have, like 51% market share, 52%? Oh wait, no, what's their market share actually?
No, they don't.
What
is their like
5% market share?
Less than 10%, but their
Oh,
market share.
So they don't even have 10% market share?
Yeah, but their market share.
Wow.
Hold on, stop.
I can't believe
stop.
they don't even have 10%.
I know, listen, bro, I know how you argue. I know all your points. I know how you make them. I know your whole, and usually I get a good pushback back. So what I would look at is less about their market share and more about the pool of data that's being dug into and the language learning models that it's being shoved into to make the conversations with the consumer that much more integrated and take that friction out of the process. So if you look at, I think when I talked to Varun Krishna a couple of weeks ago, he said something like they've got 50 million data points or 50 million, 60 million groups of data, 300,000 call logs they're combing through a week. So I mean, we're not combing through any call logs in NFM. Sorry, we're not right at this moment, right? And we're the 12th largest retail only shop in the country. Okay, we need to be, but we're not. I'm vulnerable. I like to be vulnerable. I'm a real man, Taylor. So like when you look at that,
had you on the billboard, you
need to look. You don't look at the market share. You look at the advancements and who is pouring the most into that. Who's got the hold of that? And I think they've got 90%, 95%. You know, it's probably maybe 85%. But then Loan Depot and the others that have the public funding or hedge fund money are probably leaning in as well.
Here's what I would tell you. At less than 10% market share, there's no winner. We are in the first leg of the race, not the last. And if there is an organization that's going to come out and stake their claim and run, there's plenty of opportunity. Trust me, I promise you. Now, all due deference to what Rocket has done. They've done it in a very short period of time. Remember that Rocket was Quicken Mortgage, born in the ashes of 2009, doing HARP refis, consumer direct HARP refis once upon a time. That's what Rocket is today. And they've got a long ways to go. All due respect. And trust me, I'm amazed with what they're doing on technology. What I also know is that technology is the great equalizer. It used to be that technology was going to separate the haves and the have-nots in the mortgage space. But with the introduction of AI and the opening up of the channels and the ability for people to learn how to utilize technology and leverage it, it's the great equalizer. It enables a small company to compete with a big company in so many different ways if you know how to get it out there and how to utilize it.
Well, there you go.
So I agree
that's the caveat.
Yeah, you have to know how to use it and leverage it and deploy it. So the next 12 months, my predictions, one, I see AI just doubling down, tripling down, quadrupling down. I'm using 3 or 4 different systems right now and looking at 2 more. I've got a lot of AI on the front end. I've got it in the middle of our process. We're getting ready to put some of it at the back end of our process. We're doing as much as fast as we can to speed up our flow so that our customers get a better experience. And it really does work. We're having huge success that is amazing. I think that more and more companies will find their way towards it, or those that don't and can't or don't believe in it are going to find their way out and they will get consolidated through. I think Greg made that point very, very eloquently earlier. In the next 12 months, I think we're going to see some changes that none of us have really expected. We've got between 5 and 10 million student loan borrowers that are now going to have to start repaying their student loans that have not been paying their student loans. There are a huge number that are going to be immediately delinquent and immediately have their payroll garnished and immediately have their federal income tax refunds taken. And many of those are homeowners that are going to have to choose whether they're going to pay their student loan or pay their mortgage. And guess what? The student loan isn't a choice because the federal government's just going to garnish their wages and there won't be any money left. So not to throw a damper on, but there's going to be a number of people that are going to find themselves debating on whether to exit the housing space, which will actually open up housing for those that are prepared to enter into housing space. We also have hundreds of thousands of government loans that have been in severe default since the COVID pandemic forbearance rules. And those are going to start coming to market also. There are current estimate is at least 400,000 FHA loans that have been delinquent, severely delinquent for multiple years and probably will be unable to exit that. We have a similar situation with VA. The numbers aren't so big, but the numbers are north of 40,000 and potentially as high as 70. And then on top of the 400,000 estimate for FHA across the board, we have other numbers that go up into the million number space. So there's a huge housing supply that has been locked up by homeowners that haven't been making their mortgage payments for years, utilizing the forbearance process over and over and over again. And with the ML that came out from HUD or from FHA a month or so ago, the borrowers that have been utilizing forbearance are now going to have to stick with the forbearance plan and prove that it works, or they're going to have to navigate through to an exit on the property. So we're going to start to see the impact of that. We're going to see medical debt hit the credit reports, which we have not seen in a long time. And we're going to see how that impacts credit scores. So there's a lot of shifting that is going to take place in the next 12 months. I think that we all need to buckle our seatbelts and get ready because I think it's going to create opportunities. Whenever there's conflict and controversy, there usually is also opportunity that comes out of it.
Don't forget VASP. VASP is going away too. So there's going to be that pressure on veterans that need that assistance. And then there's also the rising cost of insurance, homeowners insurance. And will the government be able to step in some way? Will insurance companies be able to get creative to be able to reward those that are making their payments on time? There's a lot going on. I would love to know your thought on the same question you asked us, Melissa. I know we're running short on time, but
yeah, I mean, you guys touched on a lot of the same ones that I have. I do think, Taylor, you're spot on. We're already starting to see some, uptick in delinquencies on government loans and on student loans. So that already is starting to come to fruition. So that part is really interesting that we'll need to keep an eye on. From a technology perspective, because I spend a lot of my time in that space, I do think I'm hopeful that we will see more agentic AI solutions coming out to market. And frankly, that is what really, really excites me. This is the type of AI that is basically Gen AI, but can go to external sources and can complete tasks and has a lower rate of hallucinations. And so having more solutions like that, I think for our industry is going to be a game changer. So those that are well positioned to be able to take advantage of those things early, I think are going to see huge lifts in their cost of origination as a result. So that is my prediction for the next 12 months.
Well, and if you could almost add a show like to your series, what does the loan officer of the future look like if most of the front end of the process is taken over by AI? We know the LO is going to still be there. There has to be some kind of a face-to-face, belly-to-belly relationship, we think. But what are they going to be doing at that point? And then what are we going to have to pay them at that point? Because they're going to be doing a lot less. So how do we right-size LO comp, which let's be honest, it should be about 80 to 85 bips tops. In the world you're talking about, you could argue 50, right? But we still have these IMBs up there at 125.
Well, we need LOs for business development, right? In a distributed retail type of format, they're the ones that have to keep the leads coming in for sure. So I think it's funny you should say that. We actually are finishing the series with a topic on the future of, preparing your companies for the next generation of mortgage professional as well as the next generation of home buyers. So we're going to chat about that in week 6. Next week, we're actually going to chat about maximizing tech adoption. That is actually one of the biggest points of feedback that I get from lenders on why they're not seeing an ROI on some of the newer solutions that they have coming out. And so we're going to spend an entire hour talking about how to maximize tech adoption with your team before we wrap up with that next generation of home buyer and next generation of mortgage professional. So we are all up at time today. I wanted to say thank you so much to Greg and Taylor. I was going to try to get us out of here before the hour, but we did not make it. But this was such a good discussion, and I just want to thank you both for sharing your time and your insights with all of us.
Pleasure, and congratulations on the launch of Praxis Lending Solutions. You're doing a great job. You're giving so much back to our industry already, like right out of the gates with your Maverick Awards, and I love following you.
Oh, thank you so much. I appreciate that. Well, everybody have a fantastic rest of your week, and we'll see you right back here again next week.